Hey there, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. It's Monday, February 5th, and welcome to the show where we try to break down the market activity based on best practices of technical analysis. A lot happened last week. I'm thinking of my conversations with some of my guests. As the charts evolved, we had a Fed meeting. We had a lot of economic data. We had a bunch of earnings, including about 20% of the S&P 500, half of the Magnificent Seven, actually slightly over half of the Magnificent Seven stocks. A lot of movements. In the end of the day, what did we learn? Well, the S&P is still very, very close to new all-time highs. We didn't get them today. We actually had a rare down close. A good reminder that the S&P can indeed close lower. But we're still pretty close to those all-time highs, driven by names like NVIDIA continuing to push to the upside. We'll talk about the strength that we're seeing underneath the hood, but also some of the weakness we're observing as well. For every NVIDIA, another growth name sort of pounding away to new highs, continuing their relentless move to the upside, we have stocks that are well below their previous highs. As a matter of fact, it's about 2 in 3 stocks still above their 50-day moving average, which means about 1 in 3 S&P stocks are actually below their 50-day moving average. So it's not like everything is going up. There are plenty of things actually showing some short-term weakness. So let's look at the charts and make sense of things as best we can today here with a market recap as we break down today's price action. Before we get to the charts and how they evolved today, I do want to address a poll that we asked over the weekend. I asked you simply, do you invest in inverse ETFs? Things like SH, SDS, these are sort of inverse ETFs, ETFs betting against the movement in the broader indexes. Interesting to see a wide dispersion of results. No one of these was really dominating in terms of the answers, but I would say about half of you said no, or but you'd be open to it, and no, it's never happening. And about half of you said, I have owned them, but just not right now, or I own some at the moment. So it really is a 50-50 split. And I think that's not super surprising, I guess, given the question. I tend to not use inverse ETFs. I do occasionally, really randomly, as kind of a short-term inverse bet. So I would have answered yes, but I don't own any right now. I have a smaller account where I'll do some inverse ETFs occasionally, which you have to remember. And I think what I would encourage you to do, thinking about some of those products like SH, SDS, and you also have to remember there are leveraged inverse ETFs where it could be double or triple short one of those benchmarks like TQQQ or something like that. Remember, these are not intended to be long-term plays. And what I find is a lot of long-term investors see these as great, easy, cheap ways to bet against a benchmark. And you can be right, but just remember that the longer you hold on to one of these, the more and more it can become disconnected from the behavior of the underlying instrument because they are designed to match a one-day % change using some sort of derivative instrument, swaps and things like that. So it's not like they're actually shorting those indexes. They're actually using some different financial vehicles to try to emulate the inverse exposure. So keep in mind that if you hold them over any longer period of time, you're really not doing what they were intended for. I would be very wary of the structural risk of those. And also, as always, make sure you do due diligence on fees and things like that, spreads, and buy-sell spreads or bid-ask spreads, and make sure you understand the details of what you're actually buying or selling. Great poll, and thanks so much for answering that one. Let's get to the market recap and see how things played out. You may notice we're using the brand new StockCharts platform. We've had a pretty big upgrade recently. A little later in today's show, we're going to have a segment called Pro Tip. We're going to hit on just a little bit of the new features that we've just released here on StockCharts. We've been rolling them out sort of quietly over the last couple weeks, and I think at this point, everyone's been turned on to the new features. So you might have a big blue banner at the top of your page, and I would encourage you to check that out. We'll hit on some of that a little later in today's show. The S&P 500 finished the day down about 1/3%. That's down to 49.43. The Dow Jones down about 0.7%. The NASDAQ Composite down 0.2%. So again, still very close to all-time highs that we've achieved here in the last couple weeks. Just off a little bit here on a Monday afternoon. Mid caps and small caps down as well. And one of the charts that we'll highlight here at some point, if we time permitting, is the differentiation. Or when I say dispersion, it basically means when there's a spread of outcomes in a particular group, is the way I'm using that word. So you have small caps trending higher, you have small caps trending lower over the last couple weeks. And what concerns me about this market environment is that's usually what happens at market tops as you have large caps continuing to go higher because there's an expected safe haven or safety trade of owning sort of those big quality names, and you're taking the more speculative bets off the table. And as a result, things like Pepsi and Walmart, and in this day and age, Meta and Nvidia are going higher because those are relatively safe, stable plays. And then the other things, right, the really wonky stuff is really starting to break down. That's really the pattern that we're seeing here so far in 2024. The VIX actually moved slightly lower, but not by much. So we're sort of in that 13 and change range. As we mentioned, VIX gets above 14, 15. I think that suggests a short-term pullback in stocks. VIX gets above 20. We'll talk about more about a further drawdown and further downside risk and how we might want to think about it. For now, we're still in a low volatility environment. Interest rates overall moving higher, and I think that's been one of the big changes that we've observed just in the last couple sessions after the Fed meeting on Tuesday and Wednesday. Wednesday afternoon is when we had the Fed press conference and the Fed announcement. No change in interest rate policy, but certainly talking about when rate cuts may occur and essentially pushing those down the road in 2024 a little further than the market had been pricing in. Stocks sold off pretty quickly on Wednesday, but by the end of last week, we're holding up just fine. Today, are kind of rolling back over just a touch, and interest rates moving back higher. So we have bond prices down. The TLT was down 2% today, while interest rates, 5-year, 10-year, 30-year points, all moving higher. Going to commodities, you can see gold, silver, both down slightly, copper down as well. You'll notice some extra decimals we have on here. Part of our new rollout is we're catching bugs like that have popped into the system. We'll get all that cleaned up here hopefully very, very soon. So sorry for a couple extra zeros, but the numbers are right. We just have a couple extra decimal places for some unknown reason. But crude oil prices actually bounced higher a little bit by about 1%. Gold, silver prices, copper prices all down as well. Finally, we have cryptocurrencies mixed overall. Bitcoin is actually down by about 0.4%. Ethereum price is actually flat. So Bitcoin, again, sort of the general theme there is, selling off after the Bitcoin ETFs were released, bouncing now up off of that 40,000 level, down right up to around 42,400, which is where we're at the moment. Looking at the 11 S&P sectors, you can see healthcare number 1, technology number 2, and by the end of the day today, those are the only 2 out of the 11 S&P sectors that actually finished in the green. All the rest of the 11 were down for the day. So healthcare and technology, thumbs up. Energy was number 3, still down about 0.25%. On the downside, you had materials, utilities, and real estate, all down 2% or more. Did want to point out one of the new features in the new Edmunds release, as we're calling it, is what we call the Keller market model. This is actually the market trend model that I share with you in chart format occasionally on the show. And I know for my Market Misbehavior Premium members, we look at this chart every week and talk about the implications of risk on 3 different time frames, really trend on 3 different time frames. On this new widget on StockCharts, you can actually see with simple arrows, which is how I wanted to do it. It's either thumbs up or thumbs down, and you can see by these 12 green boxes, for large caps, mid caps, small caps, and the NASDAQ, the trends are positive, short-term, medium-term, long-term. And that's certainly what the market has felt like. And so not surprising that our market trend model is still pretty bullish. The short-term model is what would be first to turn. So if you're looking at this, I would keep an eye to see when the S&P and probably what would happen first would be small caps, mid caps would roll over, even though they've come off not quite enough to change the configuration on the market model yet, but certainly something to think about. Let's go to a daily chart of the S&P 500 and see how things are playing out here. As I mentioned, sort of coming off a little bit, and we're going to zoom in a touch only because the most recent data is kind of compressed at the moment, just given what's happened here. So let's go to a little 6-month chart. So here's the rally that we have off the October low of last year. So for the last 3 months, essentially, making a new swing high every month. And again, sort of that big picture way of thinking about it is the rally off of the October lows, this consolidation phase from mid-December to mid-January, and then the last couple of weeks, resolving out of that pattern to the upside. Now that we've sort of continued this stepwise motion, the way that I would sort of think about this chart is to look at the lows. And Ralph Akampora, I mentioned, was in the office last week. We featured him on the show, conversation about the chart that we now have hanging here in our StockCharts office. We talked about, in uptrends, the most important thing is to pay attention to the swing lows, right? As the market is going higher, we already know that the trend is up, so we're looking for signs that that trend is changing. So a couple ways you can do it. Number one, just look for pullbacks and make sure that every time we pull back, we're making a higher low, which last week we certainly did, right? We had a higher low around 48.40, we'll call it, and that's above these previous swing lows here in mid and early January. But you can also draw trend lines. So, this trend line that I had initially drawn off of the October low, connected that to the early December lows, which lined up pretty well with mid-December, and then we finally broke that. Now, while that doesn't necessarily tell you we're going straight down, it does tell you that whatever was happening here is now changing, what we call a change of character. And I think this transition from an uptrend phase to a consolidation phase, and what you're looking for there is which way we break, and we broke higher. So now that we have sort of a new trajectory, I almost think what you want to do is draw a new trend line using this. Let's make sure we have the right line here. Draw a new trend line using the new angle, which should be kind of right there. And if we draw that line, you can see the October low, the mid-January low, and the late January low. Not too bad here. So here we have sort of this general trend on the S&P. And so as long as this trend lines hold, then this sort of larger trend that we've defined is in play. And so you're looking for if and when, it's probably not if, but more when, price breaks below that trend line. Again, it doesn't necessarily say that the uptrend is over, but it's certainly telling you that the trend, as we've observed to that point, is now changing. Something's different. And I think for that, for our purposes, a great reason to sort of revisit that chart and see if there's anything else that we might need to be aware of. All right, we're going to go to some other charts on here. The stocks, actually, let's go here first. Let's go to the advanced decline lines, because one of the things that I've noticed here, and we featured a chart on Thursday's show. We had one of the 3 and 3 was looking at large caps, mid caps, and small caps, and just thinking about the differences in those trends. And I just want to highlight that here we have the New York Stock Exchange breadth sloping downwards, right? So look at the high in late December. Look at the high in late January. Compare that to the S&P 500 itself. So just comparing these two data series, this is the risk, I think, for the current market environment. You could look at NVIDIA and other growth names, Meta and others going higher, and think this is obviously bullish. And I would tell you for those particular names, it's nothing but bullish, I think, at this point, right? The most bullish thing a chart can do is go up, and I think that's totally fair. What you also have to remember is when you see a market going higher, we also have breadth indicators that can help us qualify what we're seeing with the index itself. And when we see this particular pattern with the S&P trending higher over the last 4 weeks and the advanced decline line not sloping higher, it's actually trending lower, that divergence between those two series basically suggests internal weakness, right? That tells you the market's moving higher, but less and less stocks are participating, right? Now, that was different back here in November and December. We talked about the strong breadth conditions, which I think were totally valid, right? The S&P making a new high, breadth is all trending upwards. That's bullish, right? Market moving higher on stronger breadth is a good thing. When the market's moving higher on weaker breadth, that's not necessarily a good thing because it suggests that a lot of individual names are actually already starting to break down and are not participating in the move anymore. I think that's a rotation we're starting to observe here. You'll notice that the S&P's advanced decline line actually still is trending higher, but the mid-cap AD line is not. The small-cap AD line very much so is not. And so you have this situation where the S&P is making new highs, but all these breadth measures are not. Now, this chart gets bullish again when these breadth indicators make a new swing high, get above their December high. But for now, I would argue that's more of a cautionary signal suggesting that this uptrend may be in question. Another chart that comes to mind is this one right here. And as I've been highlighting this chart here over the last month and a half or so, we first started talking about this chart. I mean, we've referred to it many times, to be honest, but we really hit on this chart in mid-December when we got to above 85% of S&P stocks above their 50-day moving average. And looking to the left in this purple shaded area, you can see mid-July of last year, late November of 2022, and August of 2022. That's when this indicator gets up this high, and you can see that it basically coincides with some of the major short-term peaks that we've observed in the S&P 500 over the last 2 years. Now, one of my guests last week, Tony Dwyer, very correctly pointed out that when breadth indicators are that strong, just like we were here in late December, that's actually long-term bullish, and that's true. If you look 6 to 12 months out after those kind of signals, the market has tended to do very well. And I would argue that that's based on two things. Number one, just the fact that so many stocks are going up actually is a good thing. And regardless of what happens in the short term, the long-term stability of the market is probably pretty sound, which is why, if you're asking me whether the S&P is higher 6 to 12 months from now, I think that's a fair bet that will most likely be the case. But that doesn't tell us about the next 6 to 12 weeks, and I think that's the risk for this market right here. What has happened from mid-December now to late January? Well, in the last 6 weeks, this indicator's gone from 90% down to below 60% today. And today, where the S&P is just coming off of a new high on Friday, this indicator actually made a new swing low again today. So we're down about 60%. So 30% of the S&P members basically have broken down through their 50-day moving average. Now, here's the S&P way above its own 50-day moving average. And this indicator doing this tells me that many stocks do not look like the chart of the S&P, right? The S&P looks like this. NVIDIA looks kind of like this. Meta looks like this. A lot of technology, a lot of growthy names certainly look like this. But a lot of names actually do not, as evidenced by the fact that 30% of them have now failed to hold their 50-day moving average. I see that as a short-term downside risk and suggesting to me less and less likely the S&P just blows through 5,000 and doesn't look back. I think much more likely scenario, given the seasonal weakness, given the deterioration in breadth, is that we have some weaker market activity here in February and March, and that would line up with the seasonality, which would suggest a significant low in the March timeframe. Let's finish off here just with the time we have left looking at some individual names. We're still in the meat of earnings season. Last week was a pretty heavy earnings week, but I do want to highlight just some of the stocks reporting today. Caterpillar is one that reported before the open today, and what's interesting about the chart of CAT, very nice setup going into today's session, right? And if you look on Friday, just a nice breakout. We have this sort of basing pattern here with a high around 290 to 300. We finally broke out through that level about 2 weeks ago and continued higher. But if we look at the short term, you can see in what I call the candle focus chart, we opened higher. We opened around 335 today, but by the close, we had traded all the way down to around 316. By the close, we're around 320. So this is a stock that opened much higher but closed lower. Now compare that to some of the gaps we've talked about on the show recently, where you open higher and then go even further. On Friday's episode of the show, we had our top 10 charts to watch for February. Grayson Rose and I highlighted 10 different charts that we were looking at, and I forget which particular names, but I know a couple of them had gapped higher and traded higher recently, and that's a pretty encouraging sign when a stock gaps up and then additional buyers come in. The opposite happened with Caterpillar today. This is actually a short-term bearish sign in my book because we gapped higher, but that was it. Basically, investors were selling the strength in Caterpillar this morning, and by the close, we gave about 15 points back from that opening bid around 335. So I think short-term, a little bit of a concern for Caterpillar. Next chart, we'll look at McDonald's. That was another one before the open today. A bit of a disappointing earnings release in the fact that the price gapped down today. We are below the 50-day moving average. So again, that breadth indicator we just talked about with stocks breaking through their 50-day, McDonald's today actually doing that. Had been above its 50-day moving average since back here in early November of last year. Now we're gapping below there, breaking below our recent swing lows. And I think this move right here may represent a failed breakout, right? Look at the retest of that 295 level. We had a couple attempts. We finally broke out there a couple weeks ago, but look at the momentum, which has been sloping downwards. That's that bearish momentum divergence we've been worried about on some of these names. And so McDonald's gapping lower, really sort of completing that rotation. I think short term, that's a risky bet for now until we find some footing on the downside. On Semiconductor is a name reporting today, and again, as with most semiconductor names and most growth stocks, doing just fine. This is actually one of the worst worst charts on a technical basis in the semiconductor space. Most semiconductor names have held up much, much better than ON, but if you look today, gapping higher, went from around 71, we'll call it, to close around 78. This is actually gapping back above its 50-day moving average. In this case, I'd love to see over the next couple sessions, do we get a foothold above the 50-day, indicating that investors are willing to push things a little bit higher. Two other names just to finish off here, reporting after the close today, Palantir, PLTR, and Vertex Pharmaceuticals. On PLTR, I think it's at a really compelling moment. We're sort of in that limbo between two moving averages, which means one of two things most likely happens after today's report and as we open trading tomorrow. Actually, either we break above the 50-day and break above 18, in which I would say, from a technical perspective, pretty constructive breakout above resistance. The downside outcome would be we break below the 200-day and break below recent support at 16. That's a pretty bearish sign. This is one of those stocks where the range has come in, and now you're looking to see which way the stock breaks. And I think seeing which way that move occurs from today could be a very important sign of momentum to come going forward. Vertex is the last one, then we have to wrap the market recap. Kind of a nice pullback going into the report today after being recently overbought, pulling back a little bit with the RSI above 50. So we'd love to see if it can find footing above that 50-day moving average, currently just above $400 a share. That's it for our market recap. We're going to get to a segment called Pro Tip just in a minute, where we talk a little bit more about the new SharpCharts Workbench, which I've actually been using so far. If you missed some of the things I've been clicking on, a little different look to our website with some really cool improvements that I want to share with you. Before we get to that, just a couple quick announcements, and the main one is this. We love your questions. Our mailbag has been getting some really good questions from you guys over the last couple weeks. Please keep them coming. Our email is thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. And on YouTube, of course, just drop a comment below the video that you're watching. We'd love to get your feedback on our show, on the segments we're doing, but especially the questions you're running into as you are trying to make sense of these markets using charting and technical analysis tools, hopefully on the StockCharts platform. With that in mind, let us launch a pro tip. I want to share with you through the course of time here some of the ways you can supercharge your use of the StockCharts platform and your use of technical analysis. Super excited to share with you finally the Edmunds release. We have a series of product releases that we started a year or two ago and will be continuing here for the foreseeable future, going through the alphabet, naming them after physical locations here in the Washington State area. We're going to do, we just did the Edmunds release, which is a really, probably the most significant release that I've seen on StockCharts since I've been using the platform, a couple years, we'll call it, probably 20 some years. But as you're looking at the improvements that I'm sharing with you over the coming weeks, you'll see what really nice upgrades that we've made. And it hits the members dashboard, it hits the market carpet, which was long overdue for a nice set of improvements, and the SharpCharts Workbench. So we've actually changed the way that you're going to be using StockCharts in a way, but based on all the great feedback that we've been receiving over the years. So first comment to you is go to stockcharts.com/new. And if you're new to our platform, or if you're a longtime user, this is a really good place to just see the latest and greatest tools that we've been adding. You can see that it's basically every time we do a big product release, we'll have an article where we share with you all the details. If you go to this first one, this really addresses all the product releases that we've just announced here. And we're going to start with this first one called the new SharpCharts Workbench. Now, couple quick comments. If you've used our platform before, you need to do a couple things just to make sure you're using the new SharpCharts. Now, you're automatically going to get upgraded to a new version of the dashboard. It's going to look very, very similar, but some of the capabilities are improved, and we'll highlight some of those a little later. I mentioned the Keller market model. There are a couple other widgets that we've added, and this is just the beginning. We have a lot of really cool plans to allow you to customize this dashboard and really make it specific to the questions that you're trying to answer every trading day. But what I want to point out is in the upper left here, you're going to have this new little selection, which was not there before, which says default charting tool, that is. It's going to automatically say classic SharpCharts, and that's what you're familiar with. That's what you've been using probably for a long time if you've been a long-time StockCharts member, but I would encourage you to switch it to what's called the new SharpCharts. And what that means is when you type a symbol up here at the top, it's going to switch it to this new version. It's going to take a second to load, and we just have that shortly. For now, we'll be fixing that here in the near future to make it run a little faster, but that's how you know you're running the new platform. And as you look, it looks very similar in terms of the chart itself, and the charting engine has not changed. We actually have a new version of the charting engine, which we're working on, which will be in the next big release. But for now, the charts are probably going to visually appear very similar. It's going to have a friendly look, but everything outside of this, what we call the SharpCharts Workbench, has changed. And a number of things to sort of hit on for you. At the top, you'll notice you can use these drop downs to jump between different types of charts, different periods, different styles of charts, the time frame that you're looking at, and all the structural changes. A lot of things that used to be below the chart are actually right on top. so you can immediately jump to some of these. And if you've used the ACP platform, by the way, that should look familiar because some of the same functionality we've kind of ported over to the new Workbench here. You'll also notice this line, which is new just above the chart, what we're actually giving you much more flexibility with is to be able to jump between your chart lists much more quickly. One of the main ways you can make the StockCharts platform work for you is by using chart lists. That's really our main way of managing lists of symbols. We don't really have watch lists, we have chart lists because we're a chart product, and so our goal is to help you visually analyze whatever stocks or ETFs you're interested in. So when you click here, you'll find you have all the lists of your different chart lists. You can go to individual charts very quickly from that dropdown. You can also change the way you're viewing these. We had a version of that on the old SharpCharts, but this is going to make it a lot more obvious. Just to the left of there, this is a new way that you can switch between chart styles, and I would encourage you to spend some time here. This is how you basically create chart templates, right? I have a particular chart that I want to use, so I have my go-to daily chart, my go-to weekly chart. I have that candle focus chart when I just want to do a short-term look at the candle patterns. I have a chart that allows me to compare to stocks. Then I have a bunch of other ones. You can click on these little bookmark icons to put them to the top of your list. That kind of puts your favorites up here, and it also puts them on the left side of your chart. Now, we had this before, but we've upgraded this as well. You can see we can now color code these. We can add little 1 or 2 character items on here. So I have a D for the daily, a W for the weekly, and if you want to change any of those, just right-click on one of them. You can set the color, you can change the position, put the label, and I've already found this to be a great productivity enhancer because I bring up a symbol, and then I can quickly jump through some of these different charts. And what you'll notice is the way that our Workbench has been redesigned, it's actually super fast to jump between the different charts that you've had. So once you load a symbol, it's actually very easy to jump back and forth between different items. You'll also notice that my chart is actually in the middle of my screen, which is a nice little change. I'm going to go to this one. Who are we going to? Daily. We'll do 1 year daily here. All right. So this is a chart I'm just bringing up for demonstration purposes, and I will point out in the lower right corner, you can now resize your chart however you want to make it fit on a particular screen, a particular monitor. This was a feature we actually did not have before. You actually had to type in a number of pixels, which you can still do if you want, but visually you can just left click, that is, on that little circle, and you can resize the chart dynamically. You'll also probably want to set whether the charts are center aligned, which is how I have mine. So however I resize the chart, it's going to be right in the middle. You can also auto size your charts. You want to click on the upper right corner. There's a little gear icon, and that's where you can set some of those preferences. Now, all the other good stuff is below the chart. And you remember on our old Workbench, we had a lot of these drop downs. Just the interface, the UI is just much better. It's a much more modern look and feel. All the same capabilities and many more are included here. We're just giving you a little better way to do it. Things that I would point out for you in terms of new enhancements, a lot of these are similar, but I would point out this one, adjusting for dividends. This has been a frequent request because our default methodology on StockCharts is to adjust for dividends, meaning when a company pays dividends, we adjust all the historical data to compensate for that. Some people want that and some people don't. And if you click on this little selection box, it's going to adjust or unadjust the chart you're looking at based on including dividends or not. So if you've ever wondered how that's doing that or whether it's doing it, now you can actually toggle back and forth. You'll also note you have some really cool selections, and I would encourage you to spend some time going through some of these items on your own time. The next one is chart style library. So these are all the different chart templates that we have on our platform, and these are ones that we've come up with at StockCharts over the years. They're ones that our commentators have created. Classic John Murphy charts that he designed as he was originally helping Chip Anderson launch the StockCharts platform years ago. Your own chart lists, of course, are going to be on here, but we also have a lot of other ones that some of our commentators and others have contributed. So make sure that you go to those different drop downs. You'll see, for example, under experts, here's my chart that I feature on the show every day. You can apply that chart style and many others as you go through it. But the fact that it's now visual, I think, gives you a much more rich way of understanding these. You can make the thumbnails larger or smaller, and it's a great way to just see what possibilities are there for your charts. Now, when you're bringing up a particular chart list, you can then look at a summary of the data. You can have comments on the particular chart that are then stored. We also have the chart list library. So if you're looking at a particular chart list, you can immediately see all of those charts listed out visually, and again, make the thumbnails smaller or larger. So if you have a list of stocks or ETFs, a list of macro charts, you may want to just flip through them one by one. You can actually use these thumbnails to just have a quick visual view and identify which ones are breaking out or breaking down, and then click on them to make them your main chart and go through it from there. You'll see below there we can set price alerts and even more advanced technical alerts as well, and we have additional data in the lower left to help you drill down a little bit further. So this whole workbench has been upgraded, and again, the chart itself has not changed. This is still the same SharpCharts that you're probably familiar with. However, all of the capabilities that I mentioned in terms of the different ways you can manage the charts and manipulate them all new. And so I would encourage you to experiment with them. As a reminder, if you ever run into trouble, you'll see a help button just below the chart in the new SharpCharts workbench. Make sure you hit our support desk if you're running into any issues with it. We've identified a couple random bugs, which is pretty common when you have a big product release, but our development team is pretty eager to fix things as quickly as possible. So let us know if you're running any issues, and we'll make sure that we tighten things up very, very quickly. So that is the new SharpCharts workbench. And as a reminder, if you go to stockcharts.com/new, we went to this first product release. Through the course of the next couple of weeks, we're going to be going through some of the other new features that we've been adding. It's a lot of fun, some really cool capabilities, and we're really excited. This has been our development team's really primary effort for quite some time to bring some of these new features to fruition. So excited to unveil some of these, and I hope that it helps you get to some of the answers that you're trying to get to a little more quickly, a little more efficiently. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. You know, as I was mentioning earlier, we featured this last week, but I was like, I thought I put this on today's show, which I did. So here it is. Good, because I don't remember sharing this with all of you guys. This chart, I think, is an important one. Many of my guests, I've asked pretty much all of them, you know, are you bullish or bearish and why? In some way, either they've offered it up on their own or I sort of tease those insights out. And I will tell you, having talked to a number of guests here through StockCharts TV, having talked to a lot of my peers in the industry and through social media, keeping in touch with a lot of others and where they're at, I would say there are a lot of people that are very bullish right now, and I think reasonably so, given the fact that the benchmarks are going up. And I think the most bullish thing that can happen is prices are going higher, right? That's a bullish thing by definition. I would tell you, though, if you're really bullish from this point forward, you are bullish despite the fact that breadth data is not super bullish at the moment, I think is fair to say. And this is not a long-term call. I think medium-term, long-term, this market still probably has much further to go. And I think, you know, some of the things that have propelled the market to strength to date, I think still will be there in 6 to 12 months, which I think the S&P is probably higher than current levels at the end of this calendar year. We'll see what happens as the charts evolve. But I will tell you, weakness in the first quarter, I think, is going to be more of an issue than we've seen so far. January was surprisingly strong for me, given the strength that we saw in December really has continued for the S&P. So look at the S&P 500, strong November, strong December, strong January. That's this top panel. The middle panel is mid-cap, strong November, strong December, sideways January, right? By definition. Small caps, strong November, strong December, weak January. We're actually making lower highs and potentially getting close to making a lower low. So while the S&P is going up, while leading growth names are doing just fine, and the largest names still appear to be thriving, there are a lot of names that are not thriving and are actually starting to make lower highs. They're not going straight down, right? There are not a lot of stocks in free fall. So I don't think this is an obvious bear market call, but I would tell you that there are plenty of names not confirming the uptrend in January. And I think that probably plays into the thesis we've been talking about, which is a weak seasonal first quarter, probably a low in March and strength in the second and third quarter. That's the general kind of back of the envelope playbook that I'm operating on. And the action that I'm seeing in mid caps and small caps appears to be validating that. Chart number 2 is Caterpillar. When you think of an industrial name like this, I mean, industrials have really started to improve in a lot of ways, and not all of them, but certain things like commercial vehicles, where Caterpillar is at, heavy machinery, some of the big construction names are actually doing quite well. Caterpillar gapped higher today. What concerns me about this chart today after the close, they reported earnings earlier today. As we mentioned in our market recap, the stock gapped higher but closed lower. And when a stock gaps higher, that is something that usually occurs because of after hours news, right? Something over the weekend, something before the open. In the case of Caterpillar today, earnings before the open, better than expected. The stock closes up, or opens higher, that is. But what happens between that higher open and the close tells you a lot about what investors are doing about that stock after they've digested the earnings. And if a stock gaps higher and then closes higher, that tells you additional buyers are coming in, thrilled to pay even more for stocks going up. And this is what you've seen with names like Meta and others, gapping higher on earnings and then trading higher afterwards. On Caterpillar, you have the opposite. You have something that's opened higher and closed lower. And I think this is on a red flag list for me through the remainder of this week to see if buyers are willing to come in now that it's been cut a little bit from today's open. Finally, looking at Netflix, when I think about the Magnificent Seven stocks, I've been debating whether Tesla deserves a spot. I would argue probably not anymore. So maybe it's a different Magnificent Seven, or some have talked about the Magnificent Four, or even the M&M stocks, Microsoft, Nvidia, and Meta as the three big names to follow. When I'm looking at Netflix, though, I think a really bullish pattern occurred right here where we gapped higher. This was on earnings. Again, earnings weren't particularly strong, but the subscriber number was legit, and that's what caused the stock to gap higher. It gapped above $500 a share, opened around $535, $538, we'll call it, and then traded higher. And then over the next couple days, we continued higher. We got up to around $580, but in the last week, it has stalled out. And look at these long upper shadows that we've observed on a number of sessions here recently. What those long upper shadows mean, and there actually are some candle patterns that deal with this. Something like tweezer tops comes to mind if you want to go deep into your candlestick library. Google that one and you'll find some examples of that. But this is not exactly that pattern, but it does have a chart with long upper shadows. And what that means when you have a long upper shadow is we open near the lows, we trade much higher, but we close back near the lows. And so that tends to be sort of a bearish configuration, certainly in the short term, when you have long upper shadows on a day like today. Also notice the prevalence of doji candles in the last couple of days, and that's what represents indecision. The open and close are right about the same level. So it's not like we're seeing buyers coming in. We're sort of at an equilibrium. So after gapping higher, Netflix has kind of settled into that 560, 580 range. I would see this as in danger of breaking down a little bit. The RSI is still above 70, but let's see if we break down and the RSI gets below 70. That could indicate a short-term pullback, and with that green shaded area, that gap is certainly a logical downside target. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. Good luck and enjoy the new Edmunds release. We hope you enjoy our new product release, and don't forget before you leave to like and subscribe to our channel here. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.